I refer to the last month as a period of market turmoil or turbulence. I don't think of it as a crisis. And the reason is the following. We have over 4,000 banks in the United States. We have about 10,000 banks globally that are part of SWIFT and 35,000 financial institutions throughout the world. 99.999% of them opened their doors over the past month and had no problems whatsoever. Really just a few isolated idiosyncratic institutions. So I think it is not a crisis. I think it was market turbulence. It has subsided, it has stabilized, but we need to be vigilant and we need to watch for other stresses in the system.
What are your banking members saying? How are they feeling about the outlook here?
Sure, well, they're cautious. You see the fund here has marked down their forecast for this year. There's a lot of downside risk, especially in advanced economies. The emerging markets actually look a little bit better, which is nice for a change. There are risks. There are geopolitical risks, which we can talk about. But the downside risks are real, and we just don't know how deep they are. The Fed's going to probably tighten again. We have other central banks in Europe and the UK tightening. So there are risks to the downside.
It seems as though the situation, though, has again put supervisors and banking regulation back in the spotlight. Is there an expectation from the members that you speak to that we could see another round of regulation getting toughened up again?
Yeah, I don't think so. In fact, I've spoken with a number of regulators just in the last 48 hours, many of whom were instrumental in writing either Dodd-Frank or really putting together Basel III. Not a single one of them has said that we need more regulation. In fact, Secretary Yellen just yesterday said the system is well capitalized, a lot of an enormous amount of liquidity. It's a very different system than was prevailing in 2007, 2008. I do think we need to better understand what went wrong at certain institutions like SVB. I think we do need to ask what happened to supervision, but I don't think we're going to see regulatory changes.
It does feel as though we are also operating in a very different environment, namely one, social media. And this is, but we say that, but at the same time, it is having huge ramifications. And we saw it in the case of Credit Suisse back towards the end of last year. One tweet set off a massive wave of deposit outflows. We saw it in the case of SVB as well, with certain people coming on Twitter, on social media, and saying things. How does that affect how you think about banking vulnerabilities going forward? Because again, one of the lessons from this is banks could have a very sound capital and liquidity provision, but there's nothing they can do if people just start pulling out deposits faster than they can actually account for them.
Yeah, it's a great question. The speed given social media has really changed. And, we didn't see it. And maybe it's just the lack of imagination. We use it every day and it's ubiquitous, so we think, it's part of our system. That has changed since the last crisis. But I think we have to think about the flow of information, the speed of information, and the accuracy or inaccuracy of information. On March 10th, watching some of the things that were being written on Twitter, other social media, it was breathless, it was oftentimes wrong, incorrect. And so I counsel people at the time, get your facts before you start acting. But no one wants to be left out of the herd, the rush to get out of the market.
It really does feel like an area that supervisors may need to start focusing on again in the future.
Indeed, and maybe other aspects of our lives as well. But that's the X factor. That's what's different than in previous episodes.
Well, Tim, because we are at the IMF, it's not just about banking risks and financial stability risks. There are other concerns too. The IIF for a long time have talked about the rising debt situation around the world. But actually I noticed that recently there has been some moderately encouraging data, shows that DM debt has overall started to drop, albeit still at very, very high levels, 390 percentage points of debt to GDP. But emerging market debt still is on the rise. How concerned should we be, given now we are obviously operating in a much higher interest rate environment than we were a year ago, and yet debt continues to rise for EM?
Indeed. Well, it has been rising since 2010. It's a substantial increase both in the advanced and developing world. We've seen a little bit of back off from the top. Some of that is because of higher interest rates and a drop in the nominal value. But it's still quite large relative to the size of economies, and it has to be serviced, and the debt that is going to roll at a higher rate. So it's something we watch closely, and I think markets need to pay attention. And in the U.S., you have a discussion about the debt ceiling. And if the gold standard, the risk-free asset that is globally, if we see rumblings of a potential default here, imagine how that filters through the system. So hopefully the U.S. will do the right thing.
Where does that come into the discussion that's going on right now, almost an existential question about World Bank and IMF and the need for reform, especially when it comes to the debt situation that many vulnerable emerging market economies find themselves in. How do you think that the debt pile that many of these countries are sitting on is going to affect the World Bank's and IMF decision making in the future?
Yeah, well, these institutions, valued, important institutions, have been overshadowed over the past 10 years, the role of the private sector, but more importantly, the role of key bilateral lenders, like China, for example. The sheer volume and size of particular countries that have provided capital for projects or countries is enormous. So these institutions, while critical and central, don't play the kind of intermediation role they used to. They provide guidance and support and convening power, but there are other players that are now important.
And who are also lending at exorbitant rates, which is something we need to keep an eye on.
Well, and oftentimes we don't know because there isn't transparency.
Yeah.
And that's a critical component. I know the fund and the bank are working on that. We advocate. We just need to know better and have better insights on what are the variables and what are the factors by which this lending is done.
What would you say are the biggest risks in your view to the rest of this year?
Geopolitical risks keep me up at night. I was just in Japan last week and just watching Korea, Taiwan, China, Russia. It's a tough neighborhood. But U.S.-China relations are pretty tense, and I worry are going to continue to deteriorate for political reasons on both sides, which are self-reinforcing. The war in Ukraine continues and appears to accelerate with the spring thaw. So lots of geopolitical concerns around the world that I find more serious than the market turbulence of the past month.